Hey everyone, and welcome back to another innovative investment idea. My name is Dave, and in this video, I'll be going through part 2 of my post-pandemic growth portfolio to discuss the remaining holdings. In case you missed part 1, you'll find a link in both the description and as a card in the top right hand corner now. But before we get started, don't forget to hit the subscribe button if you're new to the channel to get more stock market content just like this. To end the hat-trick of e-commerce stocks, I have Amazon constituting 5% of the overall portfolio, ticker symbol Alpha Mike Zulu November. There's not much to say about this stock that hasn't already been said, but it remains one of the most solid plays in the entire market, still growing at a very healthy rate despite a valuation of well over $1 trillion at this point. We all know about Amazon.com, the largest online retailer in the world, but the company continues to expand in so many other areas, such as cloud computing with Amazon Web Services, video content including movies and TVs with Amazon Prime, Twitch for video game streaming, Whole Foods for groceries and food staples, and the list goes on and on. What's more impressive is that because of the pandemic, essentially every sub-business mentioned has seemingly benefited, as people are no doubt buying and streaming more content from their homes and still need to purchase groceries despite lockdown, and maybe even more so given the decrease in restaurant spending. The only blip against Amazon at all, if you can even call it that, was during the Q1 earnings report. Jeff Bezos stated that investors may want to take a seat and subsequently announced plans to reinvest all of the company's second quarter earnings internally into R&D to combat the pandemic and also improve the quality of life for its own workers. While the market did react negatively immediately afterwards, most investors eventually realized that a single quarter of earnings for a company that generated $280 billion in 2019, up $50 billion from 2018 levels, and as one of the savviest CEOs in the driver's seat, that there were really no long-term concerns beyond the next few months, even if the pandemic rages on. So I'll keep this one short and won't go into any more detail about this particular holding, other than I don't think there's ever a bad time to buy this stock, even at $2,700. You can see from the 1-year chart that during the March crash, the company barely dipped at all and has steadily been on the rise as it has done throughout its entire existence as a publicly traded company. I got into this one around mid-April for an average cost basis around $2,200, and on any significant pullback will happily add even more to my position, especially anything below $2,000 if that ever happens again. If you're on the sideline, definitely consider buying this stock and you'll thank yourself in 3 or 5 and definitely 10 years from now. The next stock in my portfolio is not an e-commerce stock, but rather a play on health services and also cloud computing at the same time, two industries that are naturally huge winners as a result of the pandemic. Livongo Health, ticker symbol Lima Victor Golf Oscar, IPO'd only a year ago in July 2019, and although it has garnered slight interest in recent weeks, is probably still not in the spotlight as it should be in my estimation. To explain the value proposition, the company has built an amazing system called Applied Health Signals, which combines medical devices to read blood sugar, blood pressure, and weight, for example, with real-world data from the internet specific to the user, such as weather and locations of nearby facilities, to create a tailored and actionable health maintenance plan. In a nutshell, it is kind of like getting assistance from Google Home or Amazon Alexa if they were plugged into a user's specific chronic health conditions, such as diabetes or hypertension, and even includes an occasional vocal reminder to the user to take necessary precautions or actions. The system even connects users to trained professionals employed or contracted directly by Livongo to provide remote one-on-one advice should a user require that level of medical attention. As with hypergrowth companies, in particular ones that have gone public recently, valuations can seem wild, but the revenue and user growth stories are really what investors should focus on here. For the Q1 results reported in May, Livongo reported an over 100% increase year over year for both revenue and also the number of users, with over 300,000 new subscribers. Despite the issues with the economy, the company actually raised full-year guidance for the year, but really what has my keen interest is a little bit beyond the results and potentially years in the future, since according to Livongo, there are almost 150 million Americans with at least one chronic health condition. To investors, this means there is an enormous total addressable market in the US alone, especially in a country with notable healthcare system issues and inequalities. A shift towards a stay-at-home model could be just what the doctor ordered. Analysts are predicting tremendous continued growth over the next 2 years, and what is also worth mentioning is that the company has a really healthy balance sheet of nearly $500 million in current assets compared to a minor $50 million in total liabilities. All of these factors have already pushed the stock price well north since the March levels, and while I got into this particular stock very late in May with a cost basis of $62, I'm very keen to hold this position for the next 3 to 5 years to see what kind of growth is possible for a company, as another reminder that went public less than a year ago. The next stock, with also 4% of holdings within the portfolio, is another 2019 IPO company of roughly the same market cap as Livongo called FSLY, ticker symbol Foxtrot Sierra Lima Yankee. If you haven't heard of FSLY before, that's generally because its product offerings operate behind the scenes, away from the collective consciousness of the masses, but what's key for investors to know is that it is also a market leader within a rapidly growing service segment known as cloud edge computing. In a nutshell, if the internet and all of its components live within an abstraction offering referred to as a cloud, then in theory, users separated by geography and vast distances should be able to access content with the same latency, since a cloud is not a physical place. However, that is generally not how it works in practice, because content is often stored on regional servers, and those servers need to communicate across networks in order to spread and replicate data to make it more readily available to end users. This is where FSLY comes into the picture. Its content delivery network, load balancing, and edge cloud platform enable customers to push out content quickly, but also optimize and secure traffic in the process. Here are some names counted in its customer base, as listed on their website, which include names already mentioned such as Shopify and Wayfair, but some other well-known players such as Reddit, Microsoft, and the New York Times, and many others not even listed here. FSLY has been growing its top line at a rate of approximately 50% the past couple of years, but like most young startups similar to Livongo, is still searching for profitability. In its most recent earnings report on May 6th for Q1, it reported a negative 6 cents EPS, suggesting it is somewhat close to positive net income, but even that result was still significantly better than the analyst projected EPS of negative 17 cents and was a catalyst for a huge price leap the following day. If the company can begin to scale operations effectively while controlling its cost of revenue over the next 2 to 3 years, then the sky really is the limit for this company, since it operates in such an integral technological niche in an age where data, speed, and instant gratification are right at the top of everyone's list. Moving over to the chart, we can see the company has already made significant moves over even the last month, more than doubling from the end of May, where it closed at somewhere in the 40s. I was extremely late to the party on this particular stock, with a cost basis in the high 60s, as I initiated a position only a couple of weeks ago, but even still, I am extremely bullish about FSLY's prospects over the next 3 to 5 years, and could easily see this stock doubling or tripling from the current price, especially if they can get to profitability sooner rather than later. On any kind of significant pullback, I would certainly look to potentially even reduce stakes in other holdings and pile into this particular stock and build out a much more significant weighting of the portfolio. The next stock in the portfolio represents a double down on cloud computing and a work from home beneficiary, which should both be prime industries in the post-pandemic era, but also another 2019 IPO, Datadog, ticker symbol Delta Delta Oscar Golf. With the help of the aforementioned FSLY, but predominantly huge cloud players like AWS, Microsoft AD, Alibaba Cloud, and Google Cloud Platform, many companies are heavily dependent upon or are already living in the cloud for not only sales and customer-facing operations, but many internal functions as well, such as data and code repositories. DDOG specializes in a critical layer to assist many companies in such a position by offering a complete suite of tools to help monitor and administer their cloud servers, an activity that might not bring excitement to many consumers, but nonetheless is a critical function for companies to operate effectively. This is an example of a monitoring dashboard that can be created using Datadog's integration toolset and offers a high-level overview of a company's cloud infrastructure and hosting capabilities. As is fairly obvious, the service is clearly geared towards technical personnel such as server admins and infrastructure developers. What might be more interesting to investors, however, is that for its Q1 2020 results on May 11th, DDOG reported exceptionally strong earnings, even surprising analysts with a 6 cents EPS profit for the quarter and an eye-popping 87% revenue growth year over year. While clearly the pandemic has accelerated the company's top and bottom line growth, what's really impressive when focusing in on the details is that not only did it add to its customer base, but has built strong and fruitful relationships with its current crop as well, reporting that nearly 1,000 customers were contributing $100,000 or more to its annual revenues. In other words, recurring revenue, but also indicating that the company has clearly built a product that is valued amongst companies that have integrated. Likewise to other successful companies such as Apple and Tesla, for instance, product matters and is the engine that drives a company's success. The stock chart for DDOG looks almost identical to the FSLY chart, so there really is not much more to comment on in terms of its overall upward trend. My cost basis is around 70 for this stock, and my sentiments mirror exactly those as previously stated. On any significant pullback, I would gladly snap up additional shares and look to hold for the next 3 to 5 years, as cloud computing should continue to become an increasingly important component of every company's operations. While Jack Dorsey is mostly known for his position as CEO of Twitter and his heated battles with the Trump administration and Mark Zuckerberg with regards to social media policies, Square, ticker symbol Sierra Quebec, is actually where most of Jack Dorsey's fortune is tied as a co-founder of the company and holder of roughly 1/8 of the company's outstanding shares. The company provides credit card readers and a point-of-sale solution to many small and medium enterprises, enabling them to manage payments and transact both online or cashlessly in physical stores. With the pandemic impacting the brick-and-mortar retail segment heavily, Square stock took a tremendous beating during the onset of the pandemic, but has come back strongly on optimism from investors due to a key factor I will discuss shortly. While the company's primary revenue stream remains the merchant fee applied on top of every transaction from its network of customers, and as such will continue to be married to the progress of the eventual reopening of the economy, Square actually has an underrated secondary stream in the form of Cash App, formerly known as Square Cash, an application it developed which enables users to transfer money and even cryptocurrency using just their phones. During the Q1 earnings call in May, it was revealed that Cash App revenues surged to $528 million, representing almost 40% of Square's total revenue. With the shutdown depressing retail numbers, the percentage split is clearly skewed, but if Square can continue to cultivate both streams, it should greatly benefit in the long run, with two viable sources of income, making it a potential cash cow in the future, despite the negative EPS of 2 cents per share for the current quarter. Again, as a growth stock, investors should look beyond the short-term volatility in order to collect on the pot of gold at the end of the rainbow. I've actually held this position in Square since mid-2018 at a cost basis of around 70, so it is not a new position, but I did not buy more on the dip or on the way up either. I'm still a believer in its growth and future potential, however, and could see the stock doubling over the next 5 years and become a steady performer within the payment space, especially amongst millennials and the younger generation, ahead of traditional payment operators MasterCard and Visa in the very long term. Potential investors should look for a pullback for entry or positive signs of a reopen before initiating a position at the current price levels. The next stock, which constitutes a smaller 3% of total holdings, is Spotify, ticker symbol Sierra Papa Oscar Tango. The company has become synonymous to music streaming in recent years and has benefited greatly since the pandemic, with more and more users piling into the service with fewer entertainment options to compete with. In fact, during the latest earnings report, Spotify surprised analysts with a 30% growth in users year over year to land at 130 million monthly paying subscribers overall. Because revenue growth has remained static over the last couple of years at around 20%, it seemed like the company had hit a ceiling in growth, but several key events in recent months has influenced me to be more bullish, as the company is seemingly marching towards audio dominance and is not just limiting itself to music. If we rewind back to early 2019, Spotify acquired 3 podcast-related companies for a combined $400 million. Parcast and Gimlet, both reputable podcast networks, and Anchor, a company that provides podcast creation tools. At the time, these moves did not really move the needle, but in retrospect, that attitude shift towards podcasting has set up a few substantial moves here in 2020 for Spotify, including the acquisition of streaming rights to one of the most popular podcasts on the planet, the Joe Rogan Experience.
Hello, everybody. I have an announcement. The podcast is moving to Spotify.
With the multi-year deal believed to be worth north of $100 million, Spotify would become the exclusive platform to listen to Joe Rogan from September, which analysts have pegged as having somewhere around 200 million downloads per month across all platforms and in the neighborhood of 1 million views on YouTube, usually within the first 24 hours of any podcast release. If we also include the $200 million acquisition of the Ringer network, including popular sports podcaster Bill Simmons, and the recent undisclosed agreement with Kim Kardashian West to host an exclusive show, it is clear that Spotify is barreling towards being the #1 platform for both music and podcasts, which should not be a tall order due to the general weakness in the podcast segment where no one company or provider really controls or dominates the scene, in which even Apple is a participant. It's also worth mentioning that podcast advertisers generally pay anywhere between $18 to $50 per thousand listeners, and with the gigantic shift forthcoming towards this platform due to all of the aforementioned podcasts, it's all but certain that we will see a huge swell in ad revenues over the coming years and potentially massive top-line growth. I opened my position soon after the Joe Rogan acquisition was announced, which is on May 19th, so my cost basis is around $180 per share. While the stock has already run up a fair bit since that time, if Spotify can convert incoming traffic to its platform to paying subscribers and boost its revenue dollar significantly, it would not come as a shock to see Spotify double in price over the next 3 to 5 years. New investors could look for any sort of pullback due to the overall market weakness to open a position, or simply buy in now and hold until at least after the financials later in the year are released once Joe Rogan has officially been onboarded. The next holding is Slack Technologies, ticker symbol Whiskey Oscar Romeo Kilo, and has actually been the worst performer in the portfolio, which comes as a bit of a shock since the work-from-home landscape seems optimal for its growth. The company has lagged even the indices since it went public, roughly the same time as both FSLY and Datadog, actually down about 16% during that span compared to the S&P 500, up about 12% overall. If you're not familiar with the company, Slack provides collaboration and messaging tools predominantly used for work purposes, with its main competitor in the space being Microsoft Teams. The reason I initially opened a position was because the company actually turned in an impressive recent quarter, announcing that a record 90,000 new customers had joined, both free and paid, eclipsing the number of new customer adds for the entire previous year. Paid customers also grew 28% year over year to 122,000, and large customers paying over 100,000 annually now comprise about 50% of the top line. Unfortunately, the numbers do not impress investors and analysts in the manner that Zoom has, for example, which reported 169% revenue growth for the same period and has a comparable business model. This resulted in the price run-up of $40 evaporating, and the stock has since dropped back to the low 30s. So as is typical of the stock market, even if the company reports solid numbers but is unable to crush expectations, it is still generally thought of as an underperformer. I got into this stock in early May, perhaps too hastily, with a cost basis of $30, so at the current price, this position is essentially break even. My recommendation is that new investors would be wise to take a wait and see approach if for some reason you were inclined towards this one particular stock. Personally, I would not look to add to the position even on a pullback, but would likely hold over the next quarter or so to see if the company can deliver more impressive results in the event of a second wave or prolonged effects from the pandemic. This particular position is a lukewarm hold at best. The final 12% of the portfolio comprises of 4 stocks that I've collectively classified as speculative/other, essentially not really stocks I would consider as growth in the traditional sense. And I will clarify what I mean in a moment, but these stocks are NEO, Novavax, Carnival Cruise Line, and Penn National Gaming. I'll tackle each one very briefly and explain why they ended up in this portfolio. So firstly, NEO, ticker symbol November India Oscar. This particular growth portfolio has seen sporadic positions of Tesla over the last year or so, probably my most short-term traded stock alongside AMD, and when I recently sold out when it was a tad under $1,000, I decided to use some of the profit to make a cheeky play into NEO, sometimes referred to as a Tesla of China, as a small punt back into electric vehicles with an entry price of under $6. The 2% weighting here is almost entirely speculative because I'm not really confident NEO can deliver in the long run, but with interest in the segment at all-time highs, due to the explosion of Nikola Motors and Helion of late, the goal is to try and earn a tidy profit and sell out in the near future and flip the proceeds towards potentially expanding an existing position such as Livongo or for another purpose entirely. The next stock is Novavax, ticker symbol November Victor Alpha X-ray. It's essentially impossible to guess which of the vaccine companies will eventually solve the problem of the pandemic first, and with so many competitors vying to get there, this position is really just an attempt to pick a random horse and see if it ends up winning the Kentucky Derby. Novavax has been around since 1995 and has had a rather spotty price history, hitting lows of between $3 and $4 a share as recently as late 2019, to highs all the way up to almost $300 a share in both 2001 and 2015. I've classified it as a growth in this instance, however, as it doesn't really fit into either my dividend or foundational blue chip portfolios, and when I opened my position in early May at around $40 a share, it seemed like a decent risk reward for capital growth should I luck into a winning horse. Optimistically speaking, if Novavax ends up producing a V-shot first, it wouldn't be unreasonable to think it could hit $300 a share once again, as one could imagine revenues going through the roof since every government on earth would pay hand over fist on behalf of their citizens. If it doesn't get there first, however, the stock price could easily tumble back towards the $3 lows, which is why I've only risked 4% of the portfolio here. The penultimate holding, Carnival Cruise Line, ticker symbol Charlie Charlie Lima. Cruise and airline stocks were probably the hardest hit as a result of the pandemic, and even now it would take a brave soul to guess when the travel industry might return to a level resembling what we saw before the pandemic. Probably at any point in the last decade, CCL would have been a very solid dividend stock, but here today it is definitely one that I would advise avoiding until we start seeing a real economic recovery. So the only reason I have holdings in this stock is that very fortunately I managed to open a position almost at the very bottom in late March, early April, as I recall the share shot up a day or two later when it was announced that Saudi Arabia Sovereign Fund had also opened a position. I should also point out that it's extremely rare that I ever managed to time the bottom, so there was definitely an element of luck in this. My cost basis is under $8, and that still looks like a decent risk-reward prospect some 2 or so months later, but unless there is another retest of the lows where I can get in again for under $8, I would definitely not consider adding to the position, as it would be too risky in my estimation, as bankruptcy is still a very real possibility here. Very similar to my CCL position is Penn National Gaming, ticker symbol Papa Echo November November. I opened a position also near the bottom when it was still trading in the teens. The company has been around for a long time, having been listed in 1994, so again it is not a growth stock in the traditional sense, but is my play on the multi-billion-dollar casino and gaming industry should the economy reopen anytime soon. One additional element that does make me bullish on this stock for upward growth beyond just gaming, however, is that the company did buy a large stake in Barstool Sports, a sports and pop culture blog that has the potential to expand into something of a revenue generating machine, similar to what Bill Simmons and The Ringer have done with their podcasting network. Sports and sports related content should also do well if the economy reopens, but it remains to be seen how the industry will proceed given the way things are currently unfolding with regards to a second wave, but we do know that the NBA at least will resume playing sometime next month in July under strict guidelines. As a final word, there are 3 other growth stocks I am watching very intently and could soon become components of this particular portfolio in the near future. The first is DocuSign, ticker symbol Delta Oscar Charlie Uniform, a company specializing in digital signatures for contracts and legal documents. The second is Crowdstrike, ticker symbol Charlie Romeo Whiskey Delta, a company focused on cybersecurity. And the third and final is Peloton, ticker symbol Papa Tango Oscar November, an exercise equipment and media company that focuses on home workouts. All 3 companies definitely stand to benefit from a post-pandemic world, and on any kind of market weakness, I would potentially look to start with a small position and add to it over time at the expense of potentially some of the 4 stocks mentioned in the speculative category. That about wraps it up for this video and this series. What are your thoughts on the total asset allocation of my post-pandemic growth portfolio, or just the general direction of the market and how it could affect these investments moving forward? Post them down below in addition to any other questions or comments. Also, don't forget to hit the like button if you enjoyed this video as well, and even consider subscribing to really support the channel if you haven't done so. Before I go, click on the top video here for part 1 of the post-pandemic growth portfolio breakdown in case you missed it, or the bottom video for a look at why there's still a strong reason for the market to keep increasing due to the strength of Uncle Sam and the Fed. As always, thanks for watching and I'll see you in the next one.